Hey everyone, and welcome back to Boni's Life. I'm Boni, and if you're new here, you've just stumbled upon the most intellectually rigorous, data-driven cryptocurrency analysis on all of YouTube. We don't do hype, we don't do shilling, and we certainly don't do get-rich-quick schemes. What we do here is dissect the market with the precision of a surgeon, providing you with the insights you need to navigate these volatile waters like a professional. Today, we are diving headfirst into what has been an absolutely fascinating 24-hour period in the crypto markets. The price action we've seen is a masterclass in market psychology, a complex dance between fear, greed, and institutional maneuvering. I'm going to break down exactly what moved the markets, why the assets you care about moved the way they did, and most importantly, what this means for your trading strategy in the hours and days ahead. If you haven't already, do yourself a favor and hit that subscribe button right now. Ring the notification bell because you are not going to want to miss the alpha we're about to drop. The information I'm about to share is the kind of analysis that hedge funds pay thousands for, and I'm giving it to you for free. This is raw, unfiltered, and backed by an arsenal of data that goes far beyond the surface-level noise you'll find on mainstream news or other crypto channels. So let's set the stage. As of this moment, the global cryptocurrency market capitalization is hovering around $3.079 trillion. On the surface, a 2.5% increase over the past 24 hours might seem like a reason to celebrate, but I'm here to tell you that this number is deeply misleading. It's a veneer of green paint over a structure that is showing some serious cracks. The 24-hour trading volume is sitting at a robust $155.227 billion, a figure that tells a story of its own about market participation, liquidity, and the immense transfer of wealth that is currently underway. We're going to unpack all of it. Let's start with the titan of the industry, the asset that dictates the rhythm of the entire market, Bitcoin. Currently trading at $88,525.90, Bitcoin has posted a 2.8% gain over the past 24 hours. In a market as volatile as crypto, that's a significant move. But here is where the plot thickens and where the casual observer misses the critical nuance. Bitcoin's 1-hour performance shows a gain of only 1.2%. This is a classic case of decelerating momentum. When intraday performance lags behind the 24-hour trend, it's a red flag for technical traders. It signals that the initial burst of buying pressure is waning, and the market may be entering a period of consolidation or even a reversal. This is the first of many clues we'll uncover today. Now, let's turn our attention to Ethereum, the queen of smart contracts, trading at $2,859.65. While it's up 1.6% over the last 24 hours, the critical insight here is its underperformance relative to the broader market. When you juxtapose this with the Crypto Fear and Greed Index, which is currently flashing a reading of 23 deep in the territory of extreme fear, a clear narrative emerges. Investors are de-risking. They are rotating capital out of the more speculative altcoin space and into the relative safety of Bitcoin. This is a classic flight to quality, a defensive maneuver that speaks volumes about the current market psychology. It's a market that is scared, and a scared market behaves in predictable ways. The breakdown of market capitalization confirms this story. Bitcoin dominance has swelled to 57.4%, a level that is elevated from its historical norms. This concentration of capital in Bitcoin, coupled with Ethereum's relative weakness, with a dominance of just 11.2%, paints a picture of a market that is bracing for impact. Investors are not confidently deploying capital across the board. They are consolidating their positions, reducing their exposure to risk, and waiting for a clearer signal. This is where the story of the altcoins becomes so crucial. Of the top 100 cryptocurrencies by market cap, 63 are in the green today. A 63 to 37 split sounds bullish, doesn't it? But this is another statistical illusion. The coins in the red are disproportionately the larger, more established altcoins. The coins in the green are predominantly smaller, more speculative tokens. This phenomenon, known as breadth divergence, is a significant warning sign. It indicates that the market's recovery is not broad-based and healthy, but rather narrow and speculative. It's a rally built on a shaky foundation. When we zoom in on the top 10, the picture becomes even clearer. Only 3 are showing gains: Bitcoin, Solana, and Binance Coin. Solana's 4.4% jump to $131.68 is particularly interesting, suggesting a pocket of strength in ecosystem-specific tokens. BNB's 3.9% rise to $851.26 is also noteworthy. But the struggles of Ethereum, XRP, and other major altcoins tell us that this is not a market in a healthy, sustainable uptrend. This is a market in the midst of a correction, punctuated by isolated pockets of strength. It is not a genuine continuation of the bull market, and anyone who tells you otherwise is not looking at the data. Now, let's get our hands dirty with the technicals, because this is where we separate the signal from the noise. Bitcoin is currently in a tight consolidation pattern around the $88,500 level. There are 3 critical technical levels that every single trader, from the novice to the seasoned professional, needs to have etched into their minds right now. First, the formidable resistance at $93,000. This is not an arbitrary number. It is the precise location of a descending trend line that has been acting as a concrete ceiling for Bitcoin's price for several weeks. This trend line represents the structural integrity of the current downtrend. A decisive break above this level, confirmed by a surge in volume, would be a powerfully bullish signal, potentially opening the door to a retest of the $100,000 to $110,000 range. However, a failure to breach this level will only reinforce the bearish sentiment and likely lead to further downside. Second, the critical short-term support at $86,000. This level has been tested multiple times in the past 48 hours, and so far it has held firm. The defense of this level is a small victory for the bulls, a sign that there is demand at these prices. However, a break below this level would be a significant bearish development, likely triggering a cascade of stop-loss orders and accelerating the move to the downside. This is the line in the sand for short-term traders. Third, the psychological and technical fortress at $80,000. If the $86,000 support fails, this is the next major battleground. A break below this level would be a catastrophic failure for the bulls, opening the floodgates for a much deeper correction, with potential targets at $75,000 or even lower. Multiple analysts I respect are now discussing the meaningful probability of a sub-$80,000 Bitcoin to start 2026, a scenario that we must take seriously. Let's talk about the Relative Strength Index, RSI. On the 60-minute chart, Bitcoin's RSI is approaching oversold territory, with a reading near 16. This is a classic bullish divergence signal, suggesting that the selling pressure may be nearing exhaustion. However, in a strong downtrend, RSI can remain oversold for extended periods. It is a useful tool, but it must be used in conjunction with other indicators. The key technical trigger I am watching is the interplay between the $86,000 support and the $93,000 resistance. A high volume breakout above $93,000 is a clear buy signal. A breakdown below $86,000 is a clear sell signal. The price action in the coming days will be defined by the battle between these two levels. For Ethereum, the technical picture is even more precarious. At $2,859.65, it is exhibiting profound relative weakness. The 7-day decline of roughly 7% from the $3,000 level is concerning, especially when you consider its peak of nearly $4,800 in August. This represents a significant erosion of investor confidence. The key levels for Ethereum are $2,800 as support and $3,000 as resistance. A break below $2,800 could trigger a sharp sell-off, while a move above $3,000 would be the first step towards a potential recovery. Technical analysis is a powerful tool, but it only tells half the story. To truly understand the market, we must analyze the fundamental forces that are at play. The single biggest driver of crypto market sentiment right now is the policy of the United States Federal Reserve. Bank of America has recently revised its forecast to include a December rate cut, and the CME FedWatch tool is now pricing in an 85% probability of a 25 basis point cut to 3.5%. The lower interest rates are generally bullish for risk assets like crypto, as they reduce the attractiveness of holding cash and encourage investment in higher growth assets. However, the market is also pricing in 2 additional rate cuts in 2026. This is where the narrative becomes more complex. While lower rates are a short-term positive, they also signal a weakening economy. If the Fed is cutting rates because it is concerned about a recession, that could ultimately be a negative for risk assets. This is the paradox of the current market. Bad news for the economy is good news for asset prices, but only up to a point. The recent string of softer US economic data has fueled these expectations for rate cuts. But this dynamic is a double-edged sword. If the data becomes too weak, or if inflation re-accelerates, the Fed could be forced to reverse course, which would be a major headwind for the crypto market. Speaking of inflation, the latest data shows that it remains stubbornly elevated at around 3%, above the Fed's 2% target. This limits the Fed's ability to cut rates aggressively. If inflation proves to be stickier than expected, the Fed's hands will be tied, and the easy money narrative that has propped up markets could quickly unravel. Now let's shift our focus to the institutional landscape, because this is where the big money is moving, and their actions often foreshadow the market's next major move. The announcement from MicroStrategy, the world's largest corporate holder of Bitcoin, that it is establishing a $1.44 billion USD cash reserve is a seismic event. This is a clear signal that even the most ardent Bitcoin bulls are hedging their bets and preparing for a period of heightened volatility. Even more telling is their quiet revision of their 2025 year-end Bitcoin price guidance, down from a lofty $150,000 to a more sober range of $85,000 to $110,000. This is a massive recalibration of expectations from a key market player, and it tells us that the smart money is becoming more cautious. However, the institutional story is not entirely bearish. In a landmark move, Vanguard, one of the world's largest asset managers, has announced that it is opening its brokerage platform to crypto-focused ETFs and mutual funds. This is a monumental step forward for the legitimacy of the crypto asset class. It signals that institutional adoption is not just continuing, but accelerating even in the face of a market downturn. This provides a strong underlying bid for the market, ensuring that when the sentiment does turn, there will be a fresh wave of institutional capital ready to be deployed. Examining the ETF flows provides a more granular view of institutional sentiment. On December 1st, US-based Bitcoin spot ETFs saw a modest $8.48 million in inflows. In contrast, Ethereum spot ETFs experienced a significant $79.06 million in outflows. This stark divergence is a powerful confirmation of the risk-off rotation we discussed earlier. Institutions are trimming their exposure to Ethereum and other altcoins and reallocating that capital to the relative safety of Bitcoin. This is a defensive posture, not an aggressive risk-on one. The Crypto Fear and Greed Index, with its current reading of 23, is screaming extreme fear. For a contrarian investor, this is a signal to pay close attention. Historically, periods of extreme fear have often been the points of maximum opportunity, the moments just before a significant market bottom. However, it is crucial to distinguish between a short-term bounce and a long-term reversal. A bounce is a temporary reprieve, a dead cat bounce in a downtrend. A reversal is a fundamental shift in the market's direction. While the extreme fear reading suggests a bounce is likely, a sustained reversal will require a change in the underlying fundamental drivers. The on-chain data provides further evidence of a market in distress. We are seeing a significant increase in the number of participants exiting their positions at a loss. This is a classic sign of capitulation. When both retail and institutional investors begin to sell at a loss, it indicates that the pain has become too much to bear, and they are throwing in the towel. This process of flushing out weak hands is a necessary, albeit painful, part of every market cycle. It is often in the depths of this despair that a true bottom is formed. On a more positive note, the derivatives market is showing signs of health. The overall leverage in the system is relatively well contained. This reduces the risk of a systemic cascading liquidation event, where the forced selling of one large player triggers a domino effect of liquidations across the market. The $1 billion in liquidations we've seen over the past 24 hours, while significant, is manageable and does not suggest the kind of systemic stress that we saw in previous market crashes. This underlying stability in the derivatives market provides a solid foundation for a potential recovery. Now let's synthesize all of this information into a set of actionable, probability-weighted trading scenarios. This is how professional traders approach the market, not with certainty, but with a clear understanding of the potential outcomes and their associated probabilities. Scenario 1. The bullish breakout. 35% probability. In this scenario, Bitcoin musters the strength to decisively break above the $93,000 resistance level on high volume. This would be a powerful confirmation that the bulls have regained control. The primary triggers for this scenario would be a dovish pivot from the Federal Reserve, a surge in institutional inflows into the Bitcoin ETFs, or a major positive catalyst such as a significant new adoption announcement. If this scenario unfolds, we would expect a rapid rally towards the $100,000 to $110,000 range. Ethereum and the broader altcoin market would likely follow Bitcoin's lead, resulting in a broad-based market rally. The timeline for this scenario is likely 2 to 4 weeks. Scenario 2, the consolidation grind, 40% probability. This is, in my assessment, the most likely outcome in the near term. In this scenario, Bitcoin continues to trade within the range of $80,000 to $92,500, with the $86,000 level acting as a key pivot point. We would see choppy sideways price action, with minor swings in both directions. This period of consolidation would allow the market to digest the recent volatility and for investors to gradually accumulate positions. This grind would likely last for 2 to 3 weeks and would ultimately set the stage for a more decisive move in either direction. Scenario 3, the bearish breakdown, 25% probability. In this scenario, the $86,000 support level fails to hold, and Bitcoin accelerates to the downside. The initial target would be the $80,000 support level, but a break below that could open the door to a much deeper correction, with potential targets at $75,000 or even lower. The triggers for this scenario would be unexpectedly hawkish commentary from the Fed, a significant negative regulatory development, or a broader risk-off move in global financial markets. If this scenario plays out, we could see a sub-$80,000 Bitcoin by the start of 2026, a development that would represent a significant setback for the market. The key takeaway here is the importance of risk management. Your trading strategy must be aligned with these probabilities. If you are bullish, your risk is defined by the $80,000 support level. If you are bearish, your risk is defined by the $93,000 resistance. The consolidation scenario suggests that now is a time for patience and caution, not for aggressive, high-conviction bets. Let me provide you with a concrete, actionable trading strategy for the next 24 to 48 hours based on the technical triggers we've identified. For the aggressive trader, a high-volume breakout above $93,000 is your entry signal for a long position. Your initial target should be the $100,000 level, with a secondary target at $110,000. Your stop loss should be placed just below the $86,000 support level. This trade offers a favorable risk-reward ratio, but it is a high-risk, high-reward setup. For the conservative trader, patience is your greatest asset. Wait for Bitcoin to establish a clear consolidation pattern above the $86,000 support level. A confirmed breakout above $93,000 after such a consolidation would be a much more reliable entry signal. For the short seller, a breakdown below the $86,000 support level is your entry signal for a short position. Your initial target should be the $80,000 support level. Your stop loss should be placed just above the $93,000 resistance. Given the 40% probability of consolidation, it is prudent to wait for a confirmed breakdown before initiating a short position. For the Ethereum trader, the relative weakness of Ethereum makes it a less attractive long candidate at the moment. Wait for a clear sign of stabilization above the $2,800 support level. A breakout above $3,000 would be a bullish signal, while a breakdown below $2,800 would be a bearish one. For the altcoin trader, The current environment is treacherous for speculative altcoins. Stick to the top 20 projects by market capitalization and focus on those with strong fundamentals and clear use cases. This is not the time to be chasing low-cap gems. I cannot overstate the importance of risk management. This is the single most important factor that separates successful traders from the 90% who lose money. In the current high volatility environment with the fear and greed index at 23, you must reduce your position sizes. If you typically risk 2% of your capital on a single trade, you should be risking no more than 1%. This is not about being timid, it is about being a professional. Your stop losses must be placed at logical technical levels, not at arbitrary percentage-based levels. A 5% stop loss is likely too tight in this market, while a 15% stop loss is too wide. Use the key support and resistance levels we have identified, $86,000 for Bitcoin and $2,800 for Ethereum. Take profits in stages. Do not be greedy. If you are in a long position and Bitcoin approaches the $93,000 resistance, take at least 50% of your position off the table. This locks in profits, reduces your risk, and allows you to let the remainder of your position run with a trailing stop loss. Zooming out to the longer-term picture, it is clear that the cryptocurrency market is at a critical inflection point. The 32% correction from the October high of $125,000 has confirmed that we are in a correction phase. However, corrections are a normal and healthy part of any bull market. The crucial question is whether this is a healthy pullback or the opening act of a prolonged bear market. Based on my analysis of the available data, I believe that we are in a healthy correction, not a bear market. My reasoning is threefold. First, the leverage in the system is well contained, reducing the risk of a systemic collapse. Second, institutional adoption is not only continuing but accelerating, providing a strong underlying bid for the market. And third, the Federal Reserve is poised to begin an easing cycle, which is historically bullish for risk assets. However, we must remain vigilant. A break below the $80,000 support level would be a major bearish development and would force a re-evaluation of this thesis. The key to successfully navigating this market is to remain flexible, data-driven, and unemotional. Do not fall in love with the narrative. Watch the technical levels, monitor the fundamental drivers, and adjust your strategy as the market evolves. To summarize our deep dive today, the crypto market is in the throes of a correction characterized by extreme fear, elevated volatility, and a clear rotation from altcoins into the relative safety of Bitcoin. The key technical levels to watch are the $93,000 resistance and the $86,000 support. The primary fundamental drivers are Federal Reserve policy, institutional adoption, and the broader economic outlook. The most likely scenario for the coming weeks is a period of consolidation within the $80,000 to $92,500 range, but we must be prepared for both bullish and bearish breakouts. For traders, the path forward is clear. Use the technical triggers we have identified to guide your entry and exit decisions. For long-term investors, the key is to understand that corrections are a feature, not a bug, of bull markets, and that the long-term thesis for cryptocurrency remains intact. If you found this analysis to be valuable, please do me a favor and smash that like button. Subscribe to Boni's Life for more of the most advanced cryptocurrency market analysis on YouTube. And I want to hear from you. Leave a comment below with your thoughts on the market, your trading strategy, and any questions you have about the analysis we've discussed today. Thank you for joining me. I'm Boni, and I'll see you in the next episode of Boni's Life.